Hi friends, Dr. Joe here. I hope you all are doing great and welcome to this video. In this video, we are going to discuss how the institutions trap retail traders into liquidity grabs, how the stop losses of retail traders are triggered so that the institutions can get into stocks at a very good price. Let us see how this entire thing is set up. And as a retail trader, what you can do to make sure that you do not fall into this trap. As a retail trader, many times you must have seen that the price is coming down to a very good support zone. And then you say that when the price reaches this support zone, say example, the support zone is between 100 rupees and 90 rupees. You say that as soon as the price reaches below 100 and it is above 90, you will want to enter a buy. So you prepare a plan that you're going to enter a buy at this support zone. As soon as the price reaches, you wait for the price to come up a little bit, and around 100 rupees, you enter into a buy. And you put your stop loss, say, at around 90 rupees. After you have placed the trade, you're happy because now the price has reached the support zone, and as per your calculation, the price is going to go up from here and you are going to make a good profit. But to your surprise, you are seeing that the price is constantly going down. Now, this is very, very strange. You know that 100 to 90 is a good support zone, but you see that the price is going further down. It goes further down, probably below 85, and it triggers your stop loss. And now you are in pain because now you planned your trade so well and now the trade has triggered a stop loss. But what is even worse? Even worse is the price now reverses. The price reverses and now start going in your direction. This makes you feel even bad. I'm sure as a trader, you must have seen this situation many times while you were trading. But have you ever thought, why is this happening? Why did my stop loss get triggered and then the price went back into the same direction which I was thinking that the price is going to go? We all as traders know one basic thing, that if there is demand, that means if there is a lot of buying happening, the price will automatically go up. And if there is a lot of selling happening, that means if there is a lot of supply in the market, then the price will come down. This is exactly what the institutions use against you. Yeah, the institutions have a lot of money and they want to invest it at a good price so that they can make profit out of it. So if they enter at a lower price, their exit is at a higher price. And if they enter at a higher price, their exit is at a lower price. So they keep moving the markets up and down because that is in their favor. So while as a retail trader, you are looking at the price that is coming to a support zone and you are preparing for a buy, the institutions are waiting for all the retail traders to put a buy at the support zone. And they are constantly watching all the retail traders. Now, all the retail traders are very happy that the price is coming to a support zone. They all are entering buy and putting a stop loss below the support zone. Now, the institutions, they take advantage of this situation. They continue selling this particular stock and brings the price even further down, even below the support zone, just to grab your stop losses or to grab the liquidity that you have created in the form of stop losses. So now what has happened? They grabbed all your stop loss and in return, they have entered the stock at 85 rupees where your stop loss was there. Now, because of all this buy that is happening, the price will now start going up. And this is where, as a retail trader, you are getting frustrated. But now, this is just a setup for the traders who do pullback trading. So, basically, in trading, there are two major styles of trading. One is called as a pullback trading, where you wait for the price to come to a support and then go for a buy. And the second type of trading is called the breakout trading, where you wait for the price to break out a support zone and enter a sell. Now, there are many such traders who are waiting for a breakout. As soon as the price breaks out this support zone, all these breakout traders enter into a sell. When a lot of retail traders enter into a sell, what do? they place their stop loss above the support, which has now become a new resistance. They will put their stop loss in form of buy above the resistance. Now what happens? The price came, triggered the trade. So now all the breakout traders are in a sell. Now the institutions start buying. Already they have bought a lot of stop losses of the pullback traders. Now all the trades which are in sell for the breakout traders has been triggered. Now the institutions want the price to move up quickly. So what they do? They enter into more buying positions. As they go above the new resistance zone, which was earlier a support zone, there is already a lot of stop losses of the breakout traders, which is in the form of buy. So that buys will get triggered. And because of that buys getting triggered, and the institutions already placing a lot of buy orders, the price will quickly rise from there, giving no opportunity for retail traders to enter into a next trade. So this is how institutions trick the retail traders and make money out of it. Let me give you a live example which has actually happened in our stock market. So like you can see that somewhere around in June 2024, the prices came below a very strong support zone. What actually happened? The price was in an uptrend. It came to the support zone once, twice, thrice. This is where all the retail traders thought that when the price comes back again into this support zone, we are going to put our stop losses below the support zone and make a huge profit in the market. But what actually happened? You can see that the price started coming down, down, and then one huge candle was formed, which went through the support zone, grabbing all the stop losses, and then the price went back up. So this is how institutions trap retail traders, get into the stock at a very, very good price, and then make profit as the price goes up. Now here the retail traders can enter into a trade again, but the retail traders are in a shock because they saw such a wonderful support zone. How could such a wonderful support zone get breached? But that is how smart money works. Institutions use their money smartly. Now, if you want to become a successful retail trader, you also have to learn the tricks of the institutions, the smart money concept, so that you can also make money from the markets. This is the news that came out on that particular day. Investors lost 31 lakh crores as election race gets tighter than what exit polls predicted. Now, the reason can be whatever it is, but what actually happened? The retail traders lost money. Now, you might say, sir, you've already told us the problem. What is the solution? The solution is very, very simple. Number one, always wait for the candle to get completed before you want to enter the trade. Do not execute your trade while the candle is in motion. So this way, what will happen is, if you're planning to enter a buy at a good support zone, you wait for the candle to get over. So the candle will make its move, go down, come back up. This way, if you would have actually entered the trade before the price reaches the support zone, your stop loss would have triggered. But now you are playing it smart. So you wait for the candle to get over. Let the candle make its long tail, come back up, and enter after that. Second thing, what you can do is wait for a confirmation candle. Wait for a good green candle to happen after the price leaves the support zone. This way, you're sure that you will not be a prey to liquidity grabbing. The third important thing you can do is you can go into a smaller time frame chart and look for a proper 10-20 crossover. This way, you are sure that the price has now started trending above the support zone, and then you enter into a trade. The fourth that you can see is volume. If you understand volumes well, you can look at the volumes. So these are four things you can do as a retail trader to avoid falling into this trap of liquidity grab. Keep your eyes open while you're trading. Keep reading news while you're trading. Because when something looks very, very clear and obvious, you should understand as a trader that this is a trap. So I hope traders that this video has made it very, very clear how the institutions trap you into liquidity grabs. Your job as a trader is not only to trade, but become a smart trader. Understand the game and then play the game. All retail traders don't understand this, and they are always on the other side of the table. You can understand this concept of smart money and come on the institution side of the table and start making huge amounts of profit from the markets. You have not come to the markets to get lucky. You have come to the markets to understand the game and play it well. So if you have learned something new today, smash that like button and share this video with all your friends so that they also will understand this concept and trade in a much better way and will avoid falling traps to institutional liquidity grabs. And friends, if you're still not subscribed to my channel, kindly subscribe to my channel and smash that bell icon. Because every time I see a new subscriber, I get motivated to create more such videos, to do more research, and understand the retail traders' problems, understand the investors' problem, and create videos that can help you and others like you to improve your trading and investing skills. And remember, friends, without practice, patience, and persistence, you cannot be successful in the stock markets. Well, that's all in this video. But before I sign out, as usual, I will not stop saying this. Keep learning, keep growing, keep getting better every single day. Thank you. Namaskar.